Hey everyone, as we have witnessed a radical GST 2.0 rationalization policy shift, and because of that, there's a lot of euphoria in the market among the taxpayers. So, as we have seen, the prices of the various goods and services have gone down because of rate cuts. In today's video, we are going to see the implications of this GST rate cut on the stock market. What are the likely changes that will happen in the stock market? How the stock market will take these GST changes? So, we are going to discuss all those things in this particular video. If you are a taxpayer who is also enthusiastic about investing in stock markets, then this video is for you, because we are going to break down the different sectors which are going to be affected either positively or negatively because of the changes in the GST rate structure. So this particular GST 2.0 rationalization policy shift, it provides a lot of investment opportunities. So the reform is expected to start a multi-year earnings upgrade cycles, especially favoring sectors such as automobiles, cement and infrastructure, consumer durables and electronics, logistics and FMCG. So automobiles and auto ancillaries benefit from lower prices and increased demand elasticity. Cement and infrastructure gain from reduced input cost and growing construction demand. Consumer durables, they see accelerated sales due to greater middle class affordability and also because of this festive season ensuing. Logistics is set to profit from higher volumes resulting from simplified supply chains. The FMCG sector, after short-term disruptions, should transition to volume-led growth as rural markets revive. So what are the risks and monitoring? So as an investor, we must also be aware of the risks that we might encounter on the way. So first is execution volatility. So execution volatility may lead to short-term muted response. As seen with the case of HUL, after the GST 2.0, there was suddenly a drop in its stock prices because there was a short-term muted performance. Why it happened? It happened due to temporary inventory adjustments in distribution channels. Secondly, anti-profiteering risks. They require close monitoring to ensure companies pass on the tax savings transparently to the customers and users. So non-compliance may result in penalties and reputational damage to these companies. So let's see the sector-wise, which all sectors are likely to benefit from this rate cuts in GST and which sectors are neutral, which sectors are going to be negatively impacted. So let's start with the first is automobile sector. Two-wheelers, small cars and CVs, commercial vehicles. So the tax rate has been reduced from 28% to 18%. So mechanism of stock impact, there is strong demand elasticity, lower end user prices, volume surge and inverted duty correction. So what was your observed market reaction? Nifty Auto Index surged by 5.9% in the month of September, and there were strong OEM stock rallies. What are the valuation outlook in the long term? It seems very positive because volume-led earnings and upgrade cycle will justify the PE ratio re-rating despite reaching historical mean. Second is FMCG consumer step. The GST rate has been reduced to 5% from 18% and 12%. So all the essential goods packaged food. So there is increased affordability, rural demand, revival margin, comfort due to lower input tax. So reaction has been mixed. Initially, there was broad rally followed by short-term HUL disruption, as I told you earlier, and profit booking. But for the long term, the trends are strongly positive because the structural turnaround based on sustained volume growth once the inventory is cleared. Cement and construction. The GST rates have been reduced to 18% from 28%. That lowers housing and infrastructure project cost, high profit sensitivity to pricing flexibility. The short-term impact has been immediate, sharp intraday rallies like UltraTech, Ambuja, followed by cooling off. But the long-term seems positive. Long-term tailwind from infrastructure spend, better profitability. So these are strong tailwinds. Consumer durables, the tax has been reduced to 18% from 28% like ACs, large TVs, dishwashers. So that boosts middle class consumption, strengthens domestic electronic manufacturing ecosystem. Impact has been very positive sentiment. Expected revenue boost for key listed players like Voltage, Blue Star. Long-term impact is positive, driven by increased consumer spending and festival demand alignment. Next is logistic and warehouse. Indirect benefit Cooper because benefits from elimination of barriers, volume boost from overall consumption surge across all sectors. Short-term impact has been sustained positive sentiment, efficiency gains for organized players, and long-term impact would be strongly positive because continual realization of structural benefits from a unified tax market. Sin goods, tobacco, luxury duty has been 40%, demerit slab. So sustained high regulatory tax burden, regulatory risk limits valuation multiples. One should be careful while investing in these companies. This will be a volatile initial spike was there, followed by a decline, profit booking as high taxation certainly emerged. Impact would be negative. Regulatory caps on pricing power, high tax components limit organic growth potential. So these are the sector-wise. This particular video has been made just for educational purpose. So if you have to invest in any particular sector, please speak to your financial consultant. If you find any value on this, please like it and subscribe to the channel if you are new to the channel. Thanks a lot for watching. See you in the next video.